Hello and welcome to Pitch the PM. My name is Doug Garber, and today I have a very special guest, the CEO of Hydra Host, Aaron Ginn. When I do research, I find it is super important not just to talk to the company, but also to talk to the customers and the suppliers and the competitors in the industry. You get a much more holistic view of the supply and demand dynamics within the industry, and you don't get a narrative that oftentimes can be pre-rehearsed from a management IR team. In this case, when I'm researching Nvidia and CoreWeave and the entire AI and GPU industry, I found one of the leading private companies. Hydra Host has a software that allows people to access and manage GPUs for data centers. So they're a customer. They essentially sell the Nvidia GPUs to anyone who is using AI and GPUs for their workloads. In addition to seeking out information from private companies or other people in the ecosystem, I'm also a big fan of using AlphaSense. They have a great expert library, and they also have AI technology that allows me to get to the information a lot quicker. They have a market intelligence platform that's trusted by 75% of the world's top hedge funds and 85% of the S&P 100. They use generative technology to surface key insights instantly from over 450 million premium resources, including company filings, broker research, news, and trade journals. And with the recent acquisition of Tegas, AlphaSense now offers the world's largest expert transcript library. It's 150,000 plus proprietary interviews, and that's growing by 6,000 interviews each month. Not only do you have the library, but they'll also go find experts for you. So with that, I'll hand it over to Aaron to give us a quick background of himself, his team, and then a little bit about Hydrahost.
Yeah, thanks for having me, Doug. So as you said, that we built a software platform that helps data centers monetize AI capacity. So Nvidia likes to call us the AI factory in a box, and we started working on this like 4 years ago with the thesis that data center space was going to be scarce. And that a new type of compute infrastructure was going to be deployed to data centers that actually allows them to commercialize their space directly to end customers, versus the last 20, 30 years was defined by commercialization and virtualized clouds, public cloud. And as the GPU craze started, we are the only software platform that does this. And it's a basically combination of two core technologies. It's our own bare metal provisioning software that we designed and built ourselves that will probably eventually open source to the world, but it's completely built in-house. And then we built a monetization fabric as well. So it runs both life cycles of that so that the full inventory is automated. So as a data center, you can deliver a SKU, a GPU, or a collection of them all are connected without the need of manual building with an engineer, network engineer, sysadmin guy to actually deliver it. It can be done with the sales person. It can be done with a checkout flow. It can be done via an API. And so our thesis about the space is that the GPU capacity becomes increasingly proliferate, and that it maps more to like regional aspects of capacity building, and that the local power constraints or regulatory constraints end up defining a lot more of the AI high performance computing capacity. So we're kind of the opposite play of any type of roll up. We don't think the GPU space is going to roll up into like a mega cloud. We think there's going to be like large players in multiple regions with also like smaller players as well that do something highly specialized. And a lot of it has to do with the decisions, the architecture decisions that NVIDIA is making that is only to the advantage of the data center and is against the advantage of any type of cloud-like service. So ultimately, we think the entire stack will compress down to the data center and fundamentally just getting GPU Jensen Gold. And then anything above that becomes either an aggregated platform play, we call them packagers, and there's not going to be generally like a large cloud company. We think that like to have in public cloud where there's like essentially three that operate globally. We think that there's going to be dozens around the world that like have their own localized capacity.
You're talking about the neo clouds. There's going to be dozens of neo clouds, and are you talking about regionally by country or by energy source cost center?
So neo is just new, but cloud is I think an overused term, because often when people think when cloud is like there's a website and I get something from, technically cloud means virtualization. Most of these GPUs are not delivered via any type of virtualized fabric. Most of them are delivered either through like a Kubernetes orchestration bare metal product or just straight up bare metal. And there's a bunch of like technical reasons why that is the case. So we say cloud, like there are a very handful of people that actually are doing it via cloud. And of that capacity that probably is truly virtualized, it's probably a very small fraction of their capacity because GPUs really don't like being virtualized. The reason why virtualization came about was that the CPU machine previously in the old era, like old CPU era, uh, there was a lot of conflating of the need of managing the machine to managing the customer workload. And then you also had the multi-node, the way that those talk to each other. And CPUs by themselves are not innately useful. They're not innately powerful by the individual node basis. And as well as a collective aggregate, that's what you need to even do like a basic website. And you still had to obviously clearly run the workloads of running the machine itself. That's like non-customer workloads. And that's why virtualization was created, was to help multiple machines be able to work together to aggregate that power and to separate out what's needed to run the machine and need to run the customer. So what Jensen started doing was essentially separate those out. So that's why you have CPUs on a GPU machine. The CPU doesn't really do anything but manage in and out of the actual GPU itself and the rest of like the RAM and the storage on the machine. It's a very passive instrument on the actual like in node. And there are ways that you can carve up the VRAM of the GPU into the cores, but generally speaking, it's a fully separated modular design. And as well as like the GPUs have a complete, generally it's called a RISC type of extension framework that is naturally not compatible with virtualization, and it's basically designed to actually not need virtualization. And so much so that the virtualization that's done on providers do provide GPUs virtualized. They have to punch it through the actual virtualization product to reach the GPUs because GPUs themselves are generally not virtualized. And so the cloud is essentially becoming basically like obsolete because of like what the direction is in terms of the GPU architecture, which is what allowing data centers to become relevant to customers again, because all that demand is leaving the public cloud.
No, great. That's a great overview of the technical side. I wanted to get a little bit of color on you and your team, how you guys got into this, and then also just a quick overview of your company as well. Anything you're willing to share about the size and scale and the growth of the company so far.
Yeah, so we manage tens of thousands of GPUs right now. Our market generally, because we actually manage the transactions because of we have a monetization fabric that runs the lifecycle there. We'll probably reach $250 million this year in terms of volume. We manage more data centers. We have employees, so we're like a team of just over 30, and our data center general footprint is, I think, around 50, somewhere between 50 and 60 right now. We are international, so about half of our customers are international, and we want to be the largest GPU management company in the world. So we're looking at breadth and width. We're trying to find 1 to 15 megawatt style deployments and monetize those. So we're not looking to do the big kind of mega Stargate sort of thing. That's for a handful of very frontier model type of customers. Like we're looking at existing space that's underutilized or existing capacity that's underutilized, and that they're looking for different ways of monetizing that, and then we automate that. We fell into space because we saw that data centers were not being built at a very aggressive rate. We saw that power was not being built as well, and that nobody deletes anything on the internet. So every data set that's being created with AI, fake or human generated, is going to be stored somewhere, and that the data center capacity itself was going to be highly constrained. And so when you're in that kind of environment, generally speaking, what happens is that the end customer, the data center, becomes more directly interfacing, like the stack compresses. And what we did see that was going to come was we were already on GPUs very early, and we believed that architecture direction was going to be really advantageous for data centers. Maybe because if Jensen, his ultimate opponent is public cloud, every iteration he's doing is against public cloud. The natural secondary consequence of that is advantage to data center, because that's who he has to sell his good to, right? Because Jensen is not in the business of building a data center; is in the business of providing gear to data centers. So we leaned into that direction and ended up being really over the target on that. And so what we didn't expect was the massive regionalization of capacity that was a surprise. In that GPU capacity kind of operates on a mutually assured destruction sort of like mental framework. And that is not necessarily something that you have a dollar or cents return model for, because you're doing it for other reasons, not just for it costs money and it could make money. So that was an unexpected thing in the market, and that's what's I think driven this kind of arms race, is that someone's going to be first, and nobody knows what that first is actually. And so everyone's trying to cross that first thing, whatever that line is, and that they want to be first in that space, because then they become the definitional adoption of what it means to be an AI country or adopt AI.
So, Aaron, you're mentioning Jensen is trying to empower the data centers and not necessarily the called the hyperscaler cloud companies, but his percentage of revenue towards these kind of 3 or 4 mega companies has really increased. I mean, it's up to 50%. How do you think he's thinking about, do I sell it to the big tech companies or do I sell it to all the data centers when he's the scarce resource at the moment? How do you think he's allocating those GPUs? Why is he giving it to the hyperscalers instead of the data center companies?
He's not changing his architecture for them. Like if they want to buy it and they want to use it, it's their decision, and they're doing it as a defensive posture. So people are leaving the cloud to go get GPUs elsewhere, so they had to go get some, try to keep some people there. And then same with their current GPU strategy, it's a defensive strategy, which generally means it won't work. You generally don't do what invest billions of dollars just to defend a moat. Like generally the moat's just kind of done for, and you got to like iterate your way to a different direction. So yeah, like he sells to them because why not? Like he's going to finance their own destruction. So it would work either way too. Like and that's the thing about hyperscalers, that fundamentally the model is based on commoditizing the chip. So if they, I'm sure at some moment Amazon was like, oh, well, people will still stay if we have GPUs, and it became like, okay, well, we just need to get the next version of the GPU because people want, and then they'll stay. Okay, well, for credits, okay, nobody's staying, so we need to invent training them, right? And so it was kind of an arc of people realizing what was happening. Now, like we were early on that, we kind of saw like there's no need to virtualize any of this stuff, and in fact, it's harmful for customers to virtualize it. And so it takes big companies a while to realize that they're being outmaneuvered. And so Jensen has issues in terms of down the stack to try to make it to where he can still sell billions and billions of dollars, and that's mostly like data center building projects, financing of data centers. Like he has to basically support an ecosystem to allow him to be the Apple of semiconductors. That is a non-hyperscaler kind of design fabric. But one of the reasons why CoreWeave became so successful was it was the kind of a deal between public cloud, Nvidia, and neoclouds, where like they will sell like large scale capacity into the public cloud fabric. And a lot of those deployments you're seeing, they are either done into CoreWeave or somehow CoreWeave is like co-managing. But the deployments in the GPUs, like in the cloud fabric, the public cloud fabric, are either nerfed, so like they're not the best version of what you can get. They're also clearly double over the market, like they're much more expensive. And you also get equivalents. You actually don't get the card itself. The customers that have like specific cards from AWS, those are done bare metal outside of the cloud fabric and delivered directly to an end customer, because that's what they want. So the only strategy now the public cloud has. Jensen has lots of ways he can go with this. So he can continue to sell them because they're going to buy it, like a nerfed product, or they're going to nerf it, or they'll outsource it to CoreWeave. But he wants to sell globally. He wants to sell to as many places as possible. He'd rather build something greenfield than sell it into a brownfield public cloud. But public cloud is very narrow in its response. It can either continue to basically lose customers to neoclouds and basically anyone who wants Jensen's products, or it has to make its own, and it decided to make its own. So the relationship will fray over the course of the next 2 years, especially with the proliferation of ARM in Jensen's products. But I was public like a year ago saying that was who his opponent was, and so now it's just more obvious as each vintage improves.
So what you're essentially saying is that the cloud's an obsolete product, and people just need the GPU from a data center, bare metal, and they can either get that through big tech or anyone else. You don't have to go through all the infrastructure and virtualization extra layers that big tech offers. You can get it from anywhere.
And the fact of seeing a lot of point of like So then why are people still renting then? It's because they had an operational advantage that other people don't. Like they essentially can capitalize GPUs easier because it's AWS, who's not going to give a loan to AWS, or AWS can do it off of its balance sheet because there's so much cash. That was its first mover advantage. Is that that's why it was still able to get some customers, is because it was able to just deploy that amount of capital to get the card. But as you roll forward and more people get into the space because they realize that no one stays in public cloud, that's also the explanation about why is so much data center capacity being built, is because people are leaving because they don't need it there, and that there's still things that they can iterate on to be relevant in the space, but the GPU itself is not relevant to public cloud. There could be things related to storage that they could invent, that they could build to support like machine-based reinforcement learning data. Like they could do things like that cloud is really good at. And but for the GPU itself, it's very obvious now from the data that this is a losing battle for them, and they have to play defense. That's why they're doing their own chip. Is they're not going to sell it to data centers or anything like that. They're going to offer it for cheap, and they're going to try to undercut Jensen. And but the problem that the Jensen is doing, he's going the opposite direction. So he's like saying you could get the like the cheap car, or you can get the Ferrari, but I'm going to price the Ferrari as if it's a Honda. Like that's his. He's trying to make every generation so much more powerful and powerful per flop basis, that the cheap thing is too expensive to run based on the tokens you get. So he is that's why it's really difficult to compete against Jensen if you are semi, is that he literally is the best at being the best. And he now is trying to be the best at being cheap, right? From a flops perspective. And that's also a very hard battle for Amazon to run against, is that they're not going to be able to ever build the best GPU. Just never. It's just not going to. And so he
Which
can
are
offer something
Jensen
cheap.
or Google or Amazon?
Google, Amazon, Microsoft, like they're not in the business of making semis. Like they're in the business of commercializing cheap compute to end customers and making it easy to use and selling managed services into that. Like that's its business. So it doesn't have the interest of building the best chip. It has the interest of making things cheap and expensive and large scale. But this is what's so creative about the way Nvidia is approaching it, is like rather than like bending a knee to that, they are just like, we're going to make it way better, but we're going to make it way better on the perspective of ROI. It's still going to cost more, right? So like a Blackwell is more expensive than Hopper, right? And every generation will be. But he's saying is that he's shrinking the footprint of power per square foot, power per kilowatt. So like your amount of compute you're going to be able to generate per kilowatt will only increase for him on the ROI perspective, versus that's how he's trying to defeat Amazon. Is that ROI? You'll make that Trainium just totally worthless. Like you wouldn't even want to rent it, because you could just go rent the Blackwell and have a much better ROI for your money than that, right? So it's a very creative approach. We'll see if it works. But like there's not really a competitive space for for these kind of alternative chips until like CUDA kind of fades away, or there's like some like distillation or some form of way models are running that are like not relevant to GPUs anymore. Both of those are kind of 5-year horizon sort of things. But like from a cloud versus neo cloud perspective, most of the wins are in favor of neo cloud, and the advantage a cloud has essentially is capital, which is kind of a fleeting, like over time, right? It gradually erodes because there's nothing really holding customers there.
I was reading in the AlphaSense expert network that some former Google employees were saying that their goal was to get to, in 7 or 8 years, 50% TPUs, 50% Nvidia GPUs, right? And Google's usage is for their own internal use, and some of it's to supply their cloud customers. Is not ROI efficient because you're beginning to be able to buy the Nvidia ones so cheap per token per energy source that you're just going to end up keep buying. They won't get to that ratio. It won't make economic sense. Is that kind of what you're saying?
Yeah, yeah. He's making it to where every node will be so efficient, even if it's more expensive, that you're not going to be concerned about TPUs. And that anything that doesn't fit into his ecosystem, as in NVIDIA's ecosystem, that it will be so economically not, it just won't perform anywhere close. And that token economics is in there, like think of it this way, it's demand for GPUs as an aggregate market is inelastic. demand for a particular type of GPUs is elastic. So the difference between H100 and A100 is very elastic according to the performance and the price that you're getting. And it varies according to workload and how you optimize the chip and what the customers are paying for. The demand for aggregate GPUs as a market is relatively inelastic. And so the price doesn't matter, people just want it. And what Jensen is leaning into is like the former is saying like people just want this stuff, they want the best. And so the way he's designing it, the way he's trying to compete against Google and Amazon, is saying that the ROI, even if it is cheaper as a per hour basis, you're not going to be able to get the type of performance that you need compared to him, and that's the way he's going to try to crush them. So as a simple way of explaining it, you just say like he's saying, "Good luck, I'm going to be the best." Like that's what he's fundamentally saying. Every presentation that you've seen the last year by wherever he's talking mostly to public cloud. It's shifted a little bit where he's talking about Huawei a little bit more, like against Huawei. But most of the time he's talking to the Googles, the Amazons, that sure they have a crazy amount of free cash flow. It's like you said, Google has multiple purposes inside of its company. But it says a lot that even Apple gave up on its vision of its GPU architecture because the best GPU inferencing wise in the world is on your iPhone. That's actually the best one in the world by performance, size, energy. It's amazing. So what they were trying to do, Apple was saying, because Nvidia and Apple had a huge falling out like 10 years ago when they were trying to put it into desktops and just didn't work. Reliability issues, things like that. So then they went their own, they AMD for a little bit, and then they did their own direction. But when Apple gave up on its vision of trying to apply its phone chips into data centers, and they announced, I think it was like $1 billion and whatever, a large amount of money, right? That's a pretty big sign since Apple is really good at chips and they're very good at hardware and creating a hardware encompassing environment with its software. And if they're giving up, right, and they're actually good as a product company, like it says a lot as a industry that he's just so far ahead that again, like everything, all markets move and change. There's not like an immutable fact. They're always going to be ahead. Like markets shift, and there's upward pressure on performance. There's downward pressure on cost savings. Like with any market, it's the same thing applies here. But he's so far ahead on reliability at the leading edge, and that the leading edge it continues to be the definitional growth pattern of LLMs and inferencing products. That's why he continues to maintain it until there's some shift in like how people use long tail GPUs. That would be the first place you see if long tail GPUs demand suddenly changes. Like then it opens the doors for the Trainiums of the world. There's alternative stuff, but if it's still led by the frontier edge type of product, and then it then trickles down, like you would like innovation in cars starts in a Bugatti, Porsche, Lamborghini, Ferrari, then it gets trailed down. That's the way the GPU markets currently work now, right? But until the long tail has an increase in performance and demand somehow via the way models work, then it's going to continue to go that direction. So if that makes sense.
Late last year, I was looking at doing my AI generative search on AlphaSense, and it was kind of listing all the people that started to use the TPUs and the GPUs from Amazon and Google. Started was Apple started to use Google's, and some reputable people started to use Amazon and Google Q4 of last year. That made it seem like their offering was somewhat competitive. Were those just kind of logo calling out, but they're not really using it's not really it's just a headline, but they're not really using a lot of it. People's pointing to these things over the last 6 months saying, hey, there's 2 new competitors there that have a big pocketbook. But help me understand why those are kind of moot points.
Well, most of those deals are struck that they're going to give NVIDIA products to them at cost if they agree to use their stuff for training. So most of those deals, that's the way it's structured. For example, for I know frontier model companies that use AWS, they're only using NVIDIA products. Then they agree in their contract, so they get it like basically like at cost or below cost, some sort of price on that. And I won't disclose it for my Amazon friends. I know what they're charging, but that was the deal that they struck with these model companies. Is like, hey, I'll give you 2 years. We won't make money on your NVIDIA product that we're renting you. You have to agree to use our Trainium product for a certain period of time, right? If it meets certain performance thresholds and things like that.
So it was a package deal. That's kind of what we're missing. That wasn't part of obviously the company narrative. Is this was a package deal? Try our inferior product, perhaps, and we'll give you access to this other stuff that you want, and then we can put a press release out, sort of thing.
Yep, that's exactly what happened. Yeah.
That's just why we, you got to go around the company and kind of dig in a little bit, talk to people.
Yeah, and like for the bears in the room, because everyone has bears. Like if the profit margin of Nvidia goes from, I think it's like 70 something down to 50, is it a big loss for the company? Oh yeah, right. But is it a loss in terms of semis? Absolutely not. 50% is an amazing profit margin for any like ODM, any semiconductor, any fabulous manufacturing, right? It's still like incredible. So think of the cloud problem that way. Like, is it still going to be relevant? Sure, but it's like relevant, like IBM's relevant. You're like, they exist and they're there and they do something. All right. And so like Google Cloud, Amazon, Azure, like they still will be relevant, but their rents that they were taking on the CPU side was like 40 to 50%. It was egregious. So that margin is going to go down, right? It may go down to 10, maybe 15, right, on the GPU side. But that's the only reason why they're trying to build their own chip, is that that's the only way they can maintain that margin, is they cannot have Jensen be able to have 70%, they have 50%. It just doesn't work. The math doesn't work. So that's their strategy, to try to get back up on that gross margin side. But people will still use it. Like they have a massive sales force but it's an architecture that's becoming increasingly out of date. And every generation of GPU after Blackwell will be incompatible with public cloud. And so what do they do? This is their only solution, because Jensen's literally pointing a gun at them and is like saying, "I'm going to shoot you now." Like, because the ARM, like basically because the way ARM works, it doesn't work in any of their stuff. It just absolutely doesn't work, because that ARM chip, the Grace chip, and every generation is going to include that now going forward, is proprietary to Nvidia. And so Nvidia has to basically release, if they want to support Amazon virtualization, they're now running on Jensen's virtualization package to run it, right? So it's the whole flipping of the equation. And so that's one thing about, like, so interesting on space, right? Is that Jensen took the lessons from Intel, and it's awful kind of the position they're in, because we want them to be a successful foundry / chip company. But like, he took all the lessons and he realized what they did, and he was like, okay, like this is not, I'm not going to go the same direction. And he's using all of his money and energy resources to build an ecosystem. That's why he talks so much about ecosystems. It's his moat around his core technology. So it's the CUDA stuff. It's the releasing agent LLMs, releasing inferencing products. Everything around Jensen in terms of software products are being built. His goal is to probably release something that he has himself. So you can see that in the future, very near term, you're going to see Nvidia releasing its own LLMs. Every iteration of open source LLMs, which are dominated by China right now. DeepSeek just released its new one today. Obviously, Manus just raised from, where was it, Benchmark, right? Which is crazy to kind of think that way. Manus is very popular. Quinn, their new multi-expert model, is far better than anything on our side of the ocean. And that they know that every generation of open source means more GPUs are being rented. And so, like, yeah, like he sells 50% of his market is America, 50% is international, around 25% is Asia, 25% is the rest. And of that pie grows with every open source, every software that Jensen can put on his thing grows that pie. And so, like, the rest of the stack is being built, needs to keep that in mind. Think of him as the Apple of silicon. Like, that's what he wants to be.
One of the arguments, at least, that the bears have is that Google and Amazon could start selling their chips to other data centers. Is it that they don't want to sell, or is that no one wants to buy it because they're so much inferior on their output of tokens? When you talk to the data centers, or the stuff you rent, are you only renting NVIDIA stuff? Do you rent out any Google or Amazon underutilized chips?
I mean, bears generally are always the negative personality parties that no one ever wants to be around, because they're always going to be like, and they make up like really sophistic, self-reinforcing arguments constantly. That doesn't matter what I say; they're still going to say something negative. And bears are still needed. Everyone needs a check. So that would be so beyond their capabilities as an organization. It would be crazy. Like it would. They would have to feel so desperate to counter Jensen that they would need to do that. Like, that would be an act of desperation if AWS was to do that. AWS doesn't need to do that. It needs to put it in its own fabric. To sell to other data centers, there'd have to be something else happening in the data center power space, that would mean that they would need that to happen. It would be done as a defensive move. It would not be opportune. The supply chain management and warranty of that stuff is not something you build overnight. And as well as the you can see this from the indie cards, right? The Groks and the Positrons, the Edge, and many of them are very, very good. It's so complicated, and money can't really fix that because it's like building it's like building an airplane. Like it requires so many steps in the process, and that they would have and it's such a low margin business compared to everything else that they would just go and just build a new data center. Like that's what they would do. They don't they. I think they've given ground on that. The in terms of they're making their own silicon to sell it. I think that that's just a different market that they don't want to deal with.
What do you think about as the new generations of GPUs from Nvidia and they're not compatible with the clouds? Do you think that cloud, you said we're still going to need some CPU cloud infrastructure, but how much of that work can go over to the GPU bare metal? Is it a different workload or is some of it transferable to GPUs? I mean, cloud's going to have slowing growth and negative growth once we get enough GPUs, and that's a more efficient solution. And the GPUs will just be at a data center. I know there's no security and other layers on that, but
I think the market projections around CPU growth for the next 10 years was like a couple digit points versus GPU or AI data centers like 20-30%. So like certainly it's going to grow, but yes, like the basic, they are moving workloads that you could previously run on CPUs just really inefficiently and effectively. So that stuff is moving. But GPUs can't run an application. They don't know they don't host applications so that would still have to reside in the CPU cloud. So that the one area that a public cloud could be successful in, I mentioned earlier, is managing data created by reinforcement learning. Like that's something that generally neoclouds they don't have that service built yet, so that's something that they could do because it's cheap storage, needs to be fast generally, but that's kind of this next iteration of like storage and how storage is associated with GPUs. So public cloud could find a zone there of because they are good at storage. They can provide the ubiquitous fast storage locally. But and the other zone too is that the saving grace could be that because of every market shift has the primary and secondary effects. The primary effect was like LLMs and GPUs. Secondary effects or the data center explosion. Another secondary effect is the regionalization of compute. So that has all this stuff was previously locked up as demand elements in public cloud, and now it's been released because Jensen broke the back of public cloud. So now we have this great pressure to regionalize compute. And Trump 45, he basically said this, and I guess he's fulfilling what he said, which is that he wants every country to view themselves as to be great again. So France should be great again. Germany said it's great again. I think he said this at NATO. So he's actually doing that in a kind of secondary way. And Europe is reshoring capacity. Today, the head of data centers at Microsoft said he was going to grow the European footprint by like almost 50% because they were getting a ton of feedback that like, what if there's a digital tax? What if like, you're an American company and Trump does this to you? Like, we don't trust you anymore. And so they had to say something because people were like applying pressure to them to regionalize their compute capacity. So that could also be a saving grace for public cloud is that those workloads have to go somewhere and their expertise is needed now internationally. And if you can't have liquid movement across countries, everything's more expensive. So that could be something as a secondary effect that they lead into is just go build everywhere else. So that could be a future market for them. But everything it started with China building the Great Wall around the internet. But once that kind of public, what's it called, the tragedy of the commons started happening, it created this cascading effect where there's going to be Western, and there's going to be within that, there's going to be European and American, like internet, digital infrastructures now. And there's going to be African, and then Euro, Asia, and then China kind of like infrastructures, and probably like Western China or Western American, Asian infrastructure as well. And that's just where it's going. And there's no economic reason for it. There's no like I can't tell Adam Smith would be like this is all stupid, and he would be correct from a return perspective. But when you're in an environment where people think like that Temu is a threat, to identity, like a sovereign identity, like compute is definitely going to be higher on that list of priorities to regionalize. And because eventually textiles will, like no one really cares. Like the nobody in America wants to build Nike shoes in Ohio. Like it's just 100% true. And but like high end manufacturing, drones to semiconductors, like all those things are something America will reshore. But you have to Americans just have to accept in the world like everything is going to be regionalized, and in some respects will be good, in some respects will be bad, but everything will be more expensive.
You mentioned earlier the ROI of what the data centers are getting or the customers are getting on the chips. Even though the Nvidia chips cost more per unit, they're more efficient on token output, energy usage, so they're better ROI. And I know you also shared some pricing data with me. Can you help me understand your customers' ROI, how you calculate that? And then also in the AlphaSense library, we've been reading about optimization, how they're now entering this optimization phase, and how your company fits into that. And is that part of your value add to the data centers?
So I'll answer from the perspective of fundamentally, like our raison d'etre as a company is to make data center money. And the best thing for our customers to be data centers is varying types of term structures that appeal to different market segments. Before we came around, like everybody was like, "Oh, I'll do a 3-year deal and you'll get your GPUs, right?" And that was the market for like 1-ish, 2 years. And that's again when Amazon did this massive build out because they can sell it on demand and be fine, right? Because they have so much cash on the balance sheet. And the market has shifted where less deals are done that way because fundamentally from an end user perspective, it's actually not very advantageous for them. That's like saying like every airline ticket I'm going to buy for the next year I pre-bought right now. Right. And it's just like nobody really wants to do that. And as well as the margin profile for the data center is pretty weak in that scenario because you're moving the risk to the end customer. And that's why you have a lower price. All this is very, there's no, and people like overcomplicate this because they think it's because it's technology and AI, but it works like any other asset class. It's the same thing. Like I said, airline tickets or hotel rooms, apartments, the financing structure works the same way. And so what we do as a company is we help data centers develop a richer contribution margin profile by having interruptible and on demand, short term, and allowing a lower operational cost structure to where that can be done in aggregate and programmatically. And so where they don't have to have engineers do this, they don't have to have a support team managing this. It can be done automatically. And if we know everybody pays for convenience, sometimes 10 to 15% more to get something convenience. And you can see that Uber Eats, boarding first on the airline, any other thing where you get to cut the line, Fast Pass in Disneyland. So that's like our thesis is that fundamentally nothing gets lower than a data center. Data center is the comparative advantage. There's nothing else below it. It's the physical real estate that has the servers. And so we can provide programmatic interfaces, software interfaces that can actually give people different types of term structures that can increase the return profile rather than doing a 3-year long deal that, yes, you shut the cap risk off, but at the same time, you're getting like a 5% return, which is like really crappy. So versus having a mix of things of like base capacity that's contracted and term structured, then maybe like 25% that's on demand, 25% that's interruptible. And what we see is that customers, they generally float through these cycles where they'll want to do something interruptible, then they want to do something on demand, they go back to interruptible and do something on term. And fundamentally, that's what the end user wants. Like they sometimes they need to buy something last minute, sometimes they need to do this last minute. And that's actually the argument of public cloud. That was what it came about to be, was that we can provide all this capacity relatively on demand. It'll be expensive, but you still have it and it'll be there. And if you want to do something longer term, you can come contract with us. So we're moving that for the GPU space into the actual data center, which is there's nothing else below that that is the comparative advantage. And we provide them those tools. So when a new vintage comes out, vintage is just generation of GPU. It may actually not behoove the data center to do a 3-year deal with it. It may behoove it to do actually like some 1-year deals and then some speculative capacity. And we're not telling people 100% should be speculative. I think that's irresponsible. But they didn't have the software capability to do that for because they didn't have an API that a customer could come buy something programmatically through or check out like automatically through. They would have to email them. And if you have to create that type of friction for an end customer, they're going to ask you for a discount. Like it just as you did, like if you, if you're talking about coming to Colorado, if you emailed all the hotels, you're going to ask them for a discount, right? Like, as if you, hey, I want to stay at your hotel, give me a discount. Versus you go to hotels.com, you're just going to pay it. Like, you just don't even care, right? Because it doesn't even matter, right? And that's what we're trying to move the compute space to, is that we want compute to be cheaper. We want it to be more prolific, and that's better for end users. But we want that margin that was previously occupied in cloud companies to be at the data center level.
When you say cheaper, help me understand that, because it sounds like if they're doing shorter term deals, they're going to get a higher price, and for the data center, it's going to get a higher dollar rent, per hour, because they're not getting a 3-year term, they're getting a 1 month or term, and the end user, the person, whatever, doing Copilot or whatever, is going to pay more because they're not going out as long.
Well, it'd be cheaper because there's a lot of resellers between data centers and end customers, because the data center doesn't have a software to deliver a GPU to them, and so, as well as, like, just because, like, think of it this way, right? Is like, let's say the end customer is paying $2, the platform in between is taking 50 cents, and the $1.50 goes to the rest of the data center. And so what we do is we say that, like, we're going to give that, and that would be like on demand. We're going to give that data center like the same $1.50, but the end customer is getting like $1.75 or something like that. And because there's nothing above us, there's multiple people who are doing delivery, which is fine. There's lots of services you can build on top of data center infrastructure, inferencing service, hosting models, helping you like buy tokens, and then they manage the inferencing. That's all great, right? And it's like those guys, which occupy the large, future capacity of GPUs, like utilization of GPUs, are mostly inferencing companies. They actually are not in the data center business, and they don't want to manage data centers. They don't want to be on term contracts. They want to go with demand. And so what we do is we take that compression down to where you could have a cloud-like interface with the data center, get the actual bare metal machines that you want programmatically. The data center still makes more money. The more that there's not really a situation in the market right now, because based on like how things are sold, that for the next few years, I think that's a conservative guess. The closer you get to the data center and have a relationship with the data center, generally the more money the data center is going to make. The more you abstract away from the data center, the less money the data center is going to make. That's just generally how the market kind of like works out. So but the problem is that like managing a data center relationship is extremely difficult. They're not software people. They don't know how to help you debug a GPU corruption error. They don't know how to deal with network config problems. Like they're not gonna be able to help you. So that's why you pay for all these people in between. So what we do is we say that like we could give them that software package, give them the support, and they can have in-customer direct relationships. Now we're still wholesale, right? So we don't promise you the grand whiz bang, Kubernetes environment. Like we don't do that. We don't think it's necessary, but like for GPUs, but you can use it. And so like that's our target, is like we want to be like 1 million GPUs, one of the largest GPU management company in the world, sprawl, because those larger platform companies or even training companies, they're going to going back to like, what's the market trend? Regionalization. So is Amazon, when it has customers in Southeast Asia, and when all those governments pass data sovereignty laws, or when all those companies are like, we don't want to send data to America because we don't know if we're going to get it back, which is really what's happening today, by the way. Like that's actually happening today. Like, are they going to go build a data center in Thailand? Like, or are they just going to try to code share their capacity in from another data center? Like that the market's going to go to code sharing, because there's just not really an advantage for any U.S. company to build an operational infrastructure, data center infrastructure outside of its own country. And that's, we're just going to see more and more of that happening. That they're just going to kind of like regionalize itself, and then the local people will develop and germinate. And because again, the NH100 with this provider and this provider, basically the same. Service differences, reliability differences are real. And that's why, as you know, with my article, that's why I call it like an airline analogy, is that a 737 is the same thing, right? But you have fare differences, class differences, services differences. And that's like a 10% on the total asset, which is 90%, which is the plane. And that 10% can still matter a lot, right? That people like Southwest went from the Darling to, I guess a Spirit Airlines, right? Like a Spirit Airlines joke, right? And United, which is I'm a United customer, like went from garbage bin, corrupted Continental Airlines, like made them crappy, to now being like the Darling, right? It's going to surpass Delta, right? And American Airlines now is completely lost his mojo and is like going to become an extension of like a budget airline or something like that. So that 10% could still matter because it matters for all the valuation of those companies and the return profile of those companies. But the 787 that they all use, it's the same plane. Like and so that's what it's easier to understand how data centers will be made, how GPUs will be deployed if you think of it that way, versus trying to get like wrapped into this guy did this chip or this guy did this chip. That kind of doesn't matter because the market motion is set, and that is what the direction it's going. You understand, like, does AWS want to be Airbus, right? That's the better analogy. Not does Tritium is Tritium competitive to Nvidia? It will be for certain cards, absolutely, but AWS is not Airbus. It doesn't have any of the supply chain to support that. Now AMD is Airbus or Embraer smaller, but we don't really have an Airbus alternative. Maybe it ends up being Huawei, right? But there's a whole kind of network that has to be made to actually give this to a third party to build an asset to monetize, and that's not something that is made very easily. It's Nvidia's reference library that they give to data centers. It's very, very deep and it's very comprehensive and very rich to where almost any problem you encounter, they have an answer for, like a manual, right? And this was the failure of a 300X from AMD was a lot of the manual stuff that they gave somebody a card that generally performed quite well to an H100, but when it scaled, multiple nodes get together, there was no manual. And then they went to these data centers, went to AMD, and they're like, "Hey, it doesn't work." And they're like, "Well, we don't know. We'll tell you in a year or two." Well, that's not going to really work for an airline as it did with the 737 Max. Like, we don't know when this is going to be, allowed. So Southwest, you just got to take $1 billion loss, right? Like that doesn't go very far, very fast.
You also talked about the ROI for either the data center. How do you quantify that? And then the second part of that is, it sounds like we're going from a market that was, when I think about just generally markets, when there's a lot of term, the market's tight, you want to lock up capacity. People are going more to, hey, it's more of a spot market. You're the ones coming in there and solving that problem. So by making that efficient market to create that spot, but that also is a sign of the market getting a little softer. You're not as tight if you're going to a spot market from a term market.
Yeah, it's bad for anybody in the space to live in a shortage. Like that's bad. These are all people who trade public markets that also participated in GPU lending or buying or investing. They're like, is there still a shortage? I'm like, if there's still a shortage, then that's bad for everybody. That's not a good thing, right? It's bad for customers. It's bad for data centers. It introduces a bunch of missed signals, right? Versus what you want is liquidity. That's what you want because liquidity means better margins, right? Shortages means that people pay too much, and often the person buying and investing the gear also pays too much, right? So you don't want that. Like it's a yeah. So like there's just kind of this weird assumption that like we're not going to invest in the space unless there is a shortage, which is like kind of dumb because that means your margin is naturally lower. Like you want it to be liquid. You want it to be where people want more and more of it. Like and the only way to do that is to get rid of the shortage pricing because it's creating an asymptote in return that is artificial. And so you saw this with H100s with this crazy wild swings because of the shortage. And so with H200s and Blackwells, you're not seeing
That's
that.
why I heard pricing was like, a couple of years ago, and my expert network calls from AlphaSense was like $8, a GPU, and now it's come down to call it two.
Yeah,
That's
yeah,
also
exactly. And
but
what then it creates, right, is that if you have the shortage environment, you lock people into things they don't need at an effort to gain supply just to do something. And it like related back to, we'll probably have a shortage from the tariff stuff. We had a decline of zero point 0.2 GDP because people crazy about imports. It was freaking crazy to see that number. So overinvested in inventory, which also, by the way, presupposes that tariffs will not hold. Like that's kind of the also spoken assumption around that is the markets don't believe this is actually like a real thing. So we'll see. We don't know, right? We'll see what deals happen. But when you're in that type of environment, you create a bunch of perverse incentives that reduce the ability to generate margin. And ultimately, at the fundamental day is like you're providing a good to somebody that you want them to create utilization and monetize with. So that's why we think compute should be more prolific, easier access, and cheaper. Is that it helps not only AI companies have a higher performance threshold and be able to return money It's a complementary good. So if gasoline is in a shortage environment, car companies hit the tank, right? Because it's a complementary good. They both like work off of each other. So that's like saying like I want cars to be incredibly expensive, right? And therefore gasoline has to be super cheap because not many people are going to buy gasoline. So the investors that were kind of saying that had the completely like wrong framework. The goal was like to invest in a company with maximum utilization, liquidity, with the highest margin, right? And you can't have that unless you have an ability people to transact and move and stability in the market. Because shortage will create these like spikes and like a bunch of like really weird behavior that causes people to lose money. So it's like saying like, oh, the tulip inflation bubble was great, right? It's like that. It's a very weird kind of mental model. So rather like the healthier way to view it is like, do you think GPU demand will continue to exist? Yes. Like, and are you getting? I mean, I think resoundingly yes. I don't think anyone doubts that. The question then is like, are you getting the GPU at the right capitalization rate versus the expected return? And the only way to increase return is not less GPUs on the market. That's a very mercantilist way of understanding markets. It's like, what is my term structures? What am I running on demand? Am I running short term? Am I running this? Like, it's a richer view of it, not just like there's a shortage and everyone's going to play it their year. It's moving risk to the end customer rather than treating it like a business. And so that's just bad for AI companies. So we want AI to be prolific globally because we think it's good for the world. And so we look at ROI from the perspective of multiple types of terms, and that having that complex contribution margin generates always greater returns. And that fundamentally, if you view it as I'm getting a good to move risk to the end customer, you're never going to make very much money. But if you view it as I'm going to have a base capacity that is on some term agreement, shorter term capacity, or make money, that's the right way of looking at it. And like you're going to be able to make significantly more greater returns by having that ability. And everyone in the space generally agrees with that, like from data centers who buy this stuff, but they just don't have confidence that they can actually get the shorter term customers. But that's like what we solve is because of our universal API. Hundreds of platform companies are interfacing with it, so you have liquidity regardless.
Sounds like your company comes in there and says, you guys don't want just to term out all your capacity at 5% returns, put some base load there, come to us, we'll help you play the spot market, we'll take our rent, but your returns will go up because we're going to get you a higher margin on the shorter term work. And you'll win, and the customer will win because they won't be paying for excess they don't need.
Yeah, and as well as like doing a 2-year deal versus another data center 2-year deal is a commodity, and it's just like it just drives you down even further. So versus like if you offer them something that they use today that they are more flexible on terms, not only are you making more money, but the customer's happy, and they're likely to stay with you, right? It's a little bit like try before you buy. Like, are you gonna invest all of your money in a single airline before you fly them? You're gonna fly them once, and then you're gonna then figure out based on their locations, based on the SKUs they're running, whether or not you want to invest in that airline. And that's the way data centers should view it. And as well as continuing to optimize down stack into their operational structure or infrastructure is the direction to go. Work on power rates, work on labor, work on what's your capitalization model. Like, is there a way to get like JVs going that don't require debt? Like, those are things that are better to work on, that are more like a balance sheet or chart of accounts sort of things. And a lot of them don't. They're actually good at that stuff. They haven't thought of it that way. They think that like if I get GPUs, I can build like a cloud or something like that. We think that that's like a waste of time. Data centers are never going to be able to build a competitive cloud compared to the venture-backed companies or the big public cloud companies. They can be really good at operational efficiencies and capitalization efficiencies. That is an advantage, is operational advantage. So it is something that they already know how to do. So that's why it's like viewing it as like Jensen solved the technology problem. Their job is to make it more efficient and more effective. Like that's the thing that data centers should do.
Is that what CoreWeave was talking about in their IPO by using software to increase their returns? It sounds like you go with the smaller data centers, but that's one of the things that they were talking about in their roadshow.
Yeah, I can see why they like weights and measures is very popular. I just think it's kind of a different business than they currently do now. That business is very horizontal, so I just think it's not the same sort of product. Because if you think of it as like a stack of multiple things that actually delivers to end customers, and specialization creates margin, and they don't build the wholesale space, they don't build the OEM either. They're not an ODM, so they rent wholesale space, and then they then provide like are very good. They're very they're very good at like large scale clusters. It's like they're, again, going to the airline analogy, they're very reliable, they're very on time, they treat you well, and that people will pay more for that. That's objectively true. And then they're not trying to provide a software product. So the problem with that, the software product, is that fundamentally is like a horizontally wide product. That if you're only resided to core infrastructure, it kind of loses its ability to be effective because it's verticalizing itself in a manner that is not fully attributable down stack. So I think you have to go either direction. I think you either have to say, I'm going to like go down stack, become a wholesaler, build my own servers, like operate in that zone where you can build something competitive. But when you go upper, it's like, like, okay, so we have the software product now, but like I'm also now managing data centers still, and those are not the same companies, and that's difficult to do. So I think you can do it in terms of if you're viewing it to have margin gain, which theoretically could be what's going on. But like Lambda has kind of moved itself up stack more and more and more. Caruso's gone down stack. They're being a wholesaler now. So I think you have to kind of have to go either direction. Either you give up becoming a data center like company, or you go up and you build these horizontal software products. And that's where you focus. Or you say we're going to become more and more capital and operationally efficient and go down, which means build our own buildings, have our own power contracts, have our own land, and go that direction.
What are you seeing currently in the spot and the term market in the last couple months here?
I mean, all curves have depreciation curves. It is not any different for GPUs. So what we're seeing in Blackwell is what's projected. So it's the same. It's what we forecasted. H100s on the lower end side because they're overbuilt. So we're seeing 10 to 50% less than projected. H200s are on target. A100s continue to overperform. 4090s continue to overperform. 5090s are overperforming. All the consumer card segments overperform. The return on capital on those are quite good. The Blackwell's falling so far, the curve looks fine.
When you say the return on capital, how do you kind of build out that model?
Yeah, so we base it off of payback period, IRR, and then MOIC, and we look at the pricing curves as it decays, match it up to what your financial goals are, whether you get lending, whether you're financing off balance sheet, and then that kind of gives you the kind of rate of return of like what you want to target. So generally for like debt oriented things, like we try to get as much of it done in the first year, and then try to leave the last year as margin. But there's also like newer debt structures coming out where which is what we are leaning into, is that the ability to off take the gear at the end of year 2 or mid of year 1.5. The lender takes the asset and makes really good residual on it. The residual on the stuff is really, really good. We're looking at 5 years is at least 25%, 3 years is 50%. So it's a very good residual, and sometimes the data center just doesn't want to deal with end of life stuff. So, but they can refurb and then resell it, and so you're going to see more innovative capital models like that as it takes advantage of different parts of the market, because there's both the frontier growth that was always going to be the best GPUs, and then there's going to be the distillation reasoning and reinforcement learning, which will be kind of the second or third year vintage. So both of them are doing different things. And so these like used GPUs can also be very good from a token perspective of doing reinforcement learning. So you're gonna have multiple, like an asset class, like used cars serve a different market, CarMax serves a different market than like the random dealer, new cars, financing of new cars. It's gonna look like that. It's not just gonna be, oh, A100 third year, it's done for, it's dead. Who wants this? Nobody wants this. It's over, right? Like that's just not how compute works. Someone finds a use for it. Someone finds a model to use it on, and so we see curves that work the same way.
Okay, so you're kind of you believe, like we've seen a lot of these public companies, the largest ones, kind of moving their depreciation from 5 to 6 years on these assets. It sounds like that makes sense what you're saying.
It's just the data center, because power is very limited and space is very limited. Amazon can eat it because they build these mega data centers. And like, what do they care? It's generally off balance sheet anyway. So and so they can just sit there and it's fine. But for the data centers, like they're in the business of GPU servers, they are more likely just to like move it and get rid. They would rather just get rid of it and get the next gen.
Okay.
And
Power efficiency, it sounds like. It sounds like
yeah,
that's the
yeah,
case.
exactly, right. They give it more, and like that whole thing about the T-flops curve and power curve. That same space, they could maybe generate $1 million with the Hopper, maybe 1.5. Same space with H200. Now they can generate 3 with a B200, possibly 6 or 7 with a GB200. So that's the curve that they're working against.
What's your take on the competition coming out of China? How far behind are they? Are those studies that they're actually efficient on the flops per or the tokens? What is your expert opinion on that?
The potential for Nvidia to be unseated is not his second cousin Lisa. I don't even think they even really pay attention to them anymore. It's really Huawei, because is doing kind of things that the AMD should have done. Is that they're leaning into a different category that is competitive to Nvidia. The world is not power constrained; it's silicon constrained. Only the West is power constrained, as we've just seen with the Iberian Peninsula. And Huawei is targeting the silicon constrained, power hungry areas. And from an individual node perspective, it's not that good. It's like a 3 to 4 year old, so like 2 year vintage, basically kind of zone. And Huawei's new chip that they're announcing they're trying to sell is basically like an H100. But the way they're overcoming that is through network fabric, size of cluster, and power. Like Dodge was like, let's take a 10-year-old chassis and put 600 horsepower in it. Right, that's kind of like what they're doing, and so it's not a Ferrari, it's not a Porsche, right? That's like the Jensen stuff. It's like a Dodge, right? It's like it's gonna work. It's not gonna be super awesome to drive most of the time, but like you don't have anything now, and who cares? You can put, because your gasoline is like 50 cents, a gallon. Like who cares? Just like it's a Hemi, like it's great. Like that's kind of like what they're doing, which is a different strategy. AMD's strategy was we want to be a competitor to Ferrari, where we don't like Enzo and we want to be Lamborghini, and Lamborghini got bought and is now a German car company. So like that's what they were doing. They had a different approach, and so this Huawei approach is actually better, just like objectively from analyzing markets. And as well as we know that China, when it decides to do something, is very serious about it and it will subsidize it really heavily. So the real threat now for Nvidia doesn't come from Taiwanese extended chip companies. It comes mostly from Huawei, and that depending on what happens in the next quarter, I think will tell you, which is the trajectory of trade relationships, will tell you what that ends up being. But we already know Huawei is being deployed in ally countries in Europe and in the Middle East, in some a little bit in Southeast Asia. But we already know there's Huawei stuff out there, and it is not as good on an individual node perspective, and it's not as good on any type of efficiency TFLOPS rating. But at scale, it's competitive, and you have to spend more money to run it, but it's also way cheaper to buy. But it is a different product trajectory, different vector, and it also threatens NVIDIA because there's no CUDA involved with it. So it's a completely open source framework. It's all Chinese, which means that they're probably spying on you, and there's probably lots of malware built into there somewhere that you don't know about. China does what China does. It's a very known quantity, which I don't know why people are surprised. It's like this rumor of like, did they get EUV outside of ASML? And it's propaganda. It's trying to whatever Sunday Morning Post or whatever, that a former ASML engineer, Chinese, that came back to China and supposedly did it. But lithography is not just Western. Like it's science, it's math. It's like China can do stuff like that. Like it's a very odd thing to think that only the Dutch could do it. Right? It's a machine. Anyone can build a machine, and it just takes time, and it takes energy and effort. And if you're motivated, you can get really far really fast. And so the proliferation of NVIDIA, I think, is very important to maintain the relevancy of AI frameworks and AI infrastructure. And Huawei is going to choose to embrace open source because mostly the West is closed source, so it's a counter to that. They don't care about the internet; it's just a counter to America, and they're going to ship that crap wherever it goes, and they're going to try to proliferate the world with it. And the will it ever be as good as Nvidia? No, I just don't. They don't have the foundry equipment, but it doesn't matter if it's good enough and it has an open source framework alternative to CUDA and the old Nvidia software frameworks. That's a very significant risk to Nvidia. And so we haven't seen full Huawei deployments yet. So that's also true. So we've seen lab results, we've seen rumors, we've seen supposedly some of the open source models are using Huawei stuff now. So until we see it probably in an allied country and see it work, we probably don't really have good guidance, and much of this could be propaganda. I mean, it is propaganda, but propaganda can still be true, right? It could be forward selling and ends up becoming true, right? So, but the one thing that is a known within China is that they're serious about it and that they're going to do what they do all the time. They did this with ZTE, they did this with cell phones, they did this with telecom equipment, they did this with energy products, they've done this with military equipment. This is what they do. So we should not be surprised that this is what they will continue to do. And so our counter should be NVIDIA should have trusted proliferation diffusion of NVIDIA goods to all of our allied countries. Basically, everyone on the tier 2 list should be accepted, and then we basically monitor if it goes to a tier 3 country, and we try to reclaim it if it does. It's a very simple thing for us to decide to do, but America is the unknown right now. The world doesn't know what we're doing, and so therefore Huawei looks, they're not going to run to it now. There's not a I don't think that that's true. I don't think that there's Saudis are oh my God, we're going to get some Huawei stuff now. But we got probably 6 to 8 months. And then if there's no meaningful change in the relationship on AI infrastructure or HPC stuff with Saudi, then they'll probably will, or Saudi allies, they'll probably will then entertain at least some initial deployment of a Huawei infrastructure.
It sounds like we should be doing more of a land grab and putting our infrastructure in place and not restricting people right now.
Absolutely.
Thank you for your time, Aaron. This has been great. So I want to say thank you for your time and good luck with your company. It sounds super exciting, and I learned a lot.
Yeah. Thanks, Doug. Thanks for your time.
All right. Have a good day.
See ya.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.